3 simple rules how to buy stocks for beginners. By the end of this video, you'll have a foundation to start investing, how to pick stocks, and how to know when to sell. In fact, I'm revealing my favorite strategy that will limit your risk and boost portfolio returns. We're talking stock investing today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, I'm excited about today's video. It's one of the most requested topics from the community, and we've got some really valuable information planned. I'm going to start with the basics of how to buy stocks and what you need to do to be a successful investor. That first part is going to be a little more basic, but even advanced investors are going to want to stick around because after that, I'll be revealing the 3 simple steps I use to pick stocks. I worked as an equity analyst for more than a decade, working for institutional money managers and venture capital. These 3 rules are all you need to produce double-digit returns and limit your risk. I'll also be sharing with you a link to a special report I just finished, the 10 Lies Wall Street Tells Investors. Now, these are the 10 biggest lies and cheats that Wall Street pulls on regular investors to take money from your pocket and make itself rich. You're not going to want to miss this opportunity to get that free report, and I'll be sharing more on that later. But now on to those investing basics and how to buy stocks. The most important thing we can do here is to start off with a foundation that's going to make you successful. I see so many investors get started. They turn on the TV to CNBC or they look for their favorite investing blog and they start writing down stocks they want to buy. They end up getting lousy returns. You know, the average investor made just 2.6% annually in the decade to 2013, according to Dalber. Their portfolio goes nowhere and they never reach their investing goals. I see a lot of investors like this and they ask me, why isn't my portfolio going anywhere? Why haven't I been able to stick with an investing plan? And it's because they didn't start with that solid foundation of financial planning. Before you can start even thinking about investing, you have to first think about your goals. I'm not talking about saying that you want $1 million before you retire. I'm talking about really thinking about what retirement means to you, really creating a mental picture around your goals. It's this mental picture that's going to motivate you to keep saving, to keep investing, even when your budget gets tight. Every time you think, I can't afford that $100 in my investing account this month, you're going to pull out that mental picture of your goals, and it's going to motivate you to push your budget just a little bit further, to save that money. Now that's the first thing, making those financial goals real. Next is to make sure that life doesn't get in the way of reaching those goals. Because you know, life is what happens when you're busy making other plans. It's a great quote by John Lennon and means so much for your financial goals. It's great to say that you have a plan to invest. I'm going to show you 3 ways to buy stocks and share my favorite investing strategy in a bit. But what happens when you lose your job? What happens when the kids need braces or when you just can't hide that car's check engine light with tape anymore? This is when life happens, when you have an emergency expense that sets you back a couple of grand, and it's the #1 destroyer of investing plans. Pretty soon you're taking money out of your investments. Your portfolio goes nowhere because you feel like you're taking 1 step forward and 2 steps back, so you just give up. So that second part of our financial foundation is just having the insurance you need and an emergency fund to get through life. That means life, health, and car insurance at a minimum and deductibles no more than $3,000 and an emergency fund that can cover some of these expenses. Now, I'm not going to tell you you have to have 3 to 6 months of expenses saved in an emergency fund before you start investing. That's just not going to happen for a lot of people. 2 in 5 households say they don't have enough money saved to cover a $400 emergency. I don't know how personal finance experts think that people can save 20 grand in an emergency fund. But you do need to save something to cover these emergency expenses. So we're going to aim for that first $3,000. That's going to cover just about any unexpected car repair, and it'll also cover your deductible on health insurance. It's not going to save you from that serious loss of income, but it'll start building that financial foundation that's going to keep you on your investing plan. Now, one last point before we get to those 3 ways to pick stocks, and my favorite investing strategy is to pay off that high rate debt. Now, I'm not a debt hater. I'm not going to tell you have to pay off your debt or you're going to be a failure. I had over $60,000 in student loan debt at one point and was in no rush to pay it off because I was able to refinance at a rate under 3%. I have a mortgage on a rental property that I was able to lock in at 4.5% because I lived in the house for a year. I make 15% cash returns on that house and use the money I make from it to make other investments. Using low-rate debt is a financial tool that every Fortune 500 company does. Apple, a $1 trillion company with $74 billion in cash, owes over $97 billion in debt. Why? Because it's able to use debt as a financial tool. But Apple isn't sitting around paying 18% on its credit cards. And when I met new clients as an advisor, I'd say, bring me your financial docs. Let me see where we're starting from. They'd show me their portfolio making maybe 7 or 8% return. Then I'd tell them I could guarantee them a 20% return on their money, and their faces would just light up. They'd ask me how it was possible, and it would be like a forehead slap. Pay off your credit cards. You've got 24% on your cards, 20% or so on personal loans. Putting your money in these is like a guaranteed return. Now, you don't have to pay off all your debt before you get started investing. Starting on that plan is going to get you in the habit of saving and seeing your money grow. But if you have debt at more than 14%, then you need to pay that off first. Otherwise, all the money you make is just going to be going to your creditors. I want you to make money, not your creditors. So we've got this solid financial foundation, and understand that it might take a better part of a year to get these in order, but this is where you need to start. Set your investing plan in concrete so that a little financial earthquake isn't going to shake it loose. Now, I want to do something to get a feel for what are your sticking points you're having. I want you to scroll down and share in the comments what's been your biggest hurdle to start investing. Has it been maybe with one of the foundation basics here? Has it been where to start? What's your biggest challenges to investing? So scroll down and tell us that in the comments. When you're ready to start investing, now we can decide what type of investor you are. This is hugely important, and most people have no idea. It really does matter what type of investor you are, how your personality fits with investing. Are you someone that wants to follow stocks and make your investing decisions? I know this might sound like a pointless question for someone watching a video on how to buy stocks, but it's one you absolutely need to get right. Because there are really two types of investors. First is the person that enjoys controlling their financial future, that wants to pick stocks and follow an investing plan. Then there's the person that just wants the financial future they deserve, but doesn't really care how they get there. They don't want the added stress or involvement of picking their own investments. There's nothing wrong with either of these two paths. Both can lead to the same destination, but the path you choose has to be right for you. If you're someone that wants that stress-free route, the do-it-for-me route, but you get on that path of picking stocks, you're gonna freak out during the next stock market crash, and you're gonna be miserable trying to manage your money. Conversely, if you want that engagement with your money, but you set on that other path, you're not going to be motivated to save. So you're going to pick a path and go one of two routes on how to buy stocks. Either an online platform like Ally Invest, where you can pick stocks and make your own decisions, or you can open an account with a robo-advisor that's going to do everything for you. Now, I'm going to explain each of these, some of the pros and cons of each, and then show you how to open an account and buy stocks on the online investing site I use. If you've already got an investing account or know which one you want to invest in, then jump ahead and I'll share my favorite investing strategy along with 3 simple rules for picking stocks. For someone that wants individual stocks, it used to be that you had to go through an advisor that was going to sell you on their experience, or that you couldn't manage your own investments. For this, they'd charge about a 1% fee on your money each year, or at about $100 for every $10,000 invested. Now, $100 doesn't seem too bad until you start adding it up. Every year's fees in that increasing amount as your nest egg grows. If you had $10,000 to invest and then add $500 monthly to your account, earning about a 7% annual return, you could have over $640,000 by the end of 30 years. Have an advisor do it, and those fees are going to shave off over $118,000 off your nest egg. You'll pay over $60,000 in fees, and you won't be earning money on those fees. Let me ask you, is spending a few hours a year on your investments worth $118,000? You bet it is. The most difficult part of opening an online investing account is just choosing which website to go with. Seriously, opening an account on any of these online sites takes less than 5 minutes and is super easy. Your only real decision is which one to choose. Now, there's nothing wrong with opening accounts on multiple investing sites, but you probably don't need more than a couple. I have accounts on 5 websites, but that's just because I want access to different research provided on different sites, and I like to try out different sites so I can review it for the blogs. With your own online account, you get to pick your own investments, and fees are going to be a fraction of what you pay an advisor. The downside to this is that you need that investing strategy we'll talk about in a bit. You have to make those decisions yourself. But this is all super easy, and I'm going to walk you through how to set up an investing account and how to buy stock. I'm going to use Ally Invest here, but most of these other platforms are very similar. I like Ally for a couple of reasons. First, because it's more than just an online investing platform. It's part of Ally Bank, a massive financial company that offers some of the best rates around by cutting costs being an online bank. Ally offers 24/7 customer service and everything a traditional bank has, including credit cards, auto, and home loans. Ally is an all-inclusive investing platform with one of the lowest trading fees in the industry. Buying a stock or a fund is just $4.95 per trade, and you can actually get this down even lower to $3.95 a trade with accounts over 100,000. If you do decide to go with a different investing site, ask yourself a few questions to pick the right one. What's the per trade fee? Now this is probably going to be the most important because it's going to have the biggest impact on your long-term goals. Are there any other fees? Most sites don't have an annual fee, but might charge a fee if you don't make a minimum number of trades within 3 months. You shouldn't have to worry about return check fees or other stuff like that, but always check the fees. Finally here, does the site offer other services like banking or lending? So let's walk through how to open an investing account and how to buy stock. Again, I'll be using the Ally platform as an example, and I'll leave a link to it in the video description below, but the process is going to be almost identical on any site. So here we are on the Ally Invest website. You'll start by clicking to open a self-directed trading account. Now that's up here with open an account and invest to get started. And this doesn't mean you'll be trading stocks, it just means you'll be in charge of your own money. Once you click through there, you'll scroll down to choose how you want to invest with us. And again, it's a self-directed trading account. Now this means you're going to be managing your own money as opposed to having Ally investment managers manage your portfolios for you, kind of a robo-investing idea. So we're going to click open account. Now this whole process is very easy, but I'm just going to walk you through it real quick. The first step is going to be to register your account with your name and email address. So you're going to start off by just putting your first name and last name here and then an email address and click register. Then choose whether you want to open an individual, which is a taxable account, a joint account with your partner, or any of the IRA accounts. Now these are going to be those tax deductible and tax advantaged accounts that we'll get to later. The process is really similar for all of these, so just choose one of these. We'll choose individual here and click next. Next you'll enter some basic personal information like your birth date, your social security number, country of citizenship, and your marital status. Next here is your contact information for your address. So you just put in your address, city and state and zip code. Then you'll enter your employment status and whether you work in the investment industry or as an insider to a company. Now, this is just to protect investors against insider trading, and it probably won't affect you. If you need to mark yes on any of these questions, you will know it because these are only applicable to people working in the investment industry or people that own a company. This last set of questions is just some basic investing objectives. You'll pick from 6 different goals, including growth, balanced in income. You'll also be given an option to apply using a margin on the account and to trade options. Now I recommend leaving both of these as no, as you really don't need options or margin and they're just going to cause more harm than they're worth. The last screen to open your investing account is to check the 2 boxes to acknowledge the user agreement and just verify your information. The first thing you'll see when logging into your Ally Invest account is going to be this account dashboard. And it's going to show you the balances in your different accounts. If you've got separated retirement and taxable accounts, you'll be able to see the balances in each of these. It will also show you how much available cash you have to invest and your stocks at the bottom. Across the top of your screen is the menu. 2 accounts here, My Accounts and Quotes, are what you'll use the majority of the time. The other tabs are really only useful if you're researching stocks or trading, so you can basically do everything you need from just these first 2 tabs right here. Under the My Accounts tab in the menu, you'll be able to click to your dashboard to see your balances, your account summary. You'll also be able to transfer money in or out of your account, as well as get your account records. The next tab, Quotes and Research here, is where you can click through to look at stocks and place an order. Now, Ally Invest offers investing in stocks, ETFs, options, mutual funds, fixed income, and foreign currencies. I would recommend just sticking with stocks and ETFs at first here, and that's all we'll really use in the course. Now, options are a bet on stock prices. You can buy basically a ticket to buy or sell a stock at a certain price, but you have to pay a premium for that ticket. That premium is lost whether the stock price goes up or down. Options are a tool for hedging risk, but totally unnecessary for most investors. Now, mutual funds are really the same thing as ETFs, except more expensive and with other disadvantages. You may have no choice but to invest in mutual funds in your 401k plan because there may be no other options, but stick to ETFs in your own investing accounts. Now, fixed income investments are individual bonds. For the majority of investors, anyone with less than, say, $500,000, buying bond ETFs is going to be a better idea. Buying individual bonds can be expensive if you're buying less than $100,000 or so. We'll look at some bond ETFs that will give you the exposure you need pretty cheaply. Finally, here, foreign currencies and other futures investments are very risky and you can lose a lot of money fast. These are mostly for companies and institutional investors that need to hedge risk in international sales and other risks. Now, moving your mouse over markets in the drop-down menu, we're just going to show a few options. You can click on US markets to take you to a general page that shows market news, a chart of the market, and some other popular stocks. On almost all pages on the site, you'll see a small box in the upper right corner with Get Quote. This is where you can put in the stock symbol or the name and go directly to a page of a stock or an ETF. When you're just getting started, you'll have to find all the ETFs and individual stocks in which you want to invest. Now, I'll be going through a list of ETFs that are going to give you great diversification within the asset classes and some options you have for the core piece of your portfolio. This will be the 65 or 70% of your money that you have invested broadly, so you get those stable market returns and don't have to worry about your money. We'll look at these funds in the next module, where we walk through each decade and look at how investments change as you age. Once you've invested in that initial group of 5 or 6 ETFs and maybe some stocks, you can invest more in each easily from your dashboard or holdings page. So let's say you want to buy some shares of the Vanguard REIT Index. Now, this is an ETF that holds shares in hundreds of real estate investment companies. It's a great way to get your real estate exposure because it's diversified across property types and across the country. The expense ratio is just 0.12%, which is extremely low compared to individual REITs. So you would come over here to Get Quote and type in the ticker symbol, which is VNQ. Now, if you can't remember the ticker symbol or you don't know it, you can also start typing out the name of the fund or the stock. On any stock or fund page, there will be 2 buttons to buy or sell shares. Now, that's going to take you to the main page for this investment. It's going to show you charts, analysis, and highlights of the fund. Clicking on the buy button takes you to an easy order page. Divide the amount you want to invest by the current price for how many shares you want to buy. So if I had $100 and it's $8 a share, I would go 100 divided by 8, 12.5. Since I can't buy fractional shares, I'll do 12 shares. I'll toggle on market for the price and click preview order. And that's it. There's really not much to it other than picking which funds and stocks you want to invest in initially. Now, the alternative to managing your own investments but still keeping those fees low is to go with a robo-advisor like Wealthsimple or Betterment. Robo-advisors put your plan on autopilot with smart technology and low-cost funds. Now, I know a lot of people are still a little hesitant to put their money in the hands of a machine, but robo-advisors really are a great way to reach your financial goals without worrying about which stocks to buy. Robo-advisors use a computer program to take your financial goals and answers to an investor profile and design an automated investing plan around that. You'll start off by answering a few questions about your goals and your needs. Then the platform is going to spread your money across different types of stocks and bonds and funds for instant diversification. Now, anytime you invest money, it's going to be automatically invested in these funds. Besides that do-it-for-me process, another one of the benefits to robo-advisors is that you never pay a commission to put your money to work. Instead of paying that $5 every time you buy a stock like on online investing sites, the robo-advisor is going to charge a flat 0.5% to make all of your investments. For example, Wealthsimple charges a 0.5% fee on accounts under $100,000 and a 0.4% for larger accounts. That means your total investing expense is going to be $50 for an account with $10,000 invested. By comparison, if you were to invest in 5 funds and put new money in every 3 months on an online platform, you would pay over $100 in commissions a year. As with all robo-investing services, Wealthsimple rebalances your account automatically, so your investments are never far from that plan that's going to best fit your goals. That computer program is going to change your investments as you age to make sure that you're getting that highest return to meet your goals, but without too much risk. Now, why I invest with Wealthsimple from some of those other robo-advisors is that it understands that sometimes you still want to talk to that person about your investments. So the platform has a team of investment advisors to answer questions through the phone, text, or email. It's a completely free service and really a way to bridge that gap between traditional advisors and robo-advisors. So those are your 2 investing options depending on what type of investor you want to be. And again, there's nothing wrong with being either one. It really depends on how much engagement you want with your investments. I'll leave a link to both of those sites in the video description below so you can get more information on either one. Now, before we get to those 3 simple rules I use to buy stocks, I want to share my favorite investing strategy. And this is really for those that want to pick stocks, that want for those 3 steps to finding their investments. So this core satellite strategy is one that most money managers follow because it's so effective at limiting your risk, but still getting those higher returns. So the idea here is that you might put maybe 65 or 75% of your money in broad funds. Now, these can be market funds or ones that invest in dividend stocks, international companies, or even in different sectors. This core part of your portfolio is going to diversify your investments so no one company or sector can destroy your wealth. Now, that diversification is going to give you market returns and keep you from freaking out when all the executives of your favorite company get indicted for fraud. But if you want to pick those individual stocks, you want that control of your investments and the potential for higher returns. So that's why you have this satellite portion of your portfolio. The rest of your money, maybe that 25 or 35%, you use to pick individual stocks with these 3 rules that we'll talk about next. Since it's only about 1/3 of your money, those individual stock picks are going to give you the opportunity for higher returns, but they aren't going to weigh on your overall portfolio if you can't pick stocks like the Oracle of Omaha. So now we're on those 3 simple rules I use to buy stocks, the 3-step process that's going to help you be a better investor. Thank you for sticking with me, and understand that those basics we talked about in that favorite investing strategy are time well spent. Honestly, that how you invest and that foundation we built is way more important than what you invest in, so make sure you start with those basics. My first step to pick stocks is to always start with a top-down look at sectors and industries. Very few people, maybe a handful of professional investors like Buffett or Peter Lynch, have ever been able to just pick great companies, but you can start with an advantage by looking at the bigger picture first. This means looking at the economy and stock sectors like utilities, financials, and energy, understanding which are going to do well over the next few years. You're looking for those broader trends in the economy and in business. It's much easier to spot these broader, bigger market trends that are going to boost certain stock sectors than to just start off by trying to pick stocks. In fact, as good as he is at picking stocks, Warren Buffett uses this approach, and you can see it in his portfolio. Buffett has invested almost $60 billion. That's nearly 1/3 of his money in banking stocks. He looked at rising interest rates, which are good for banks. He looked at deregulation in the industry and technological progress, and saw that these all came together for a great outlook in the group. That table was actually part of a Warren Buffett investing series we did here on the channel, looking at his investments and how Buffett picks stocks. I'll leave a link in the video description below because it really was an interesting look at how he beats the market for more than 50 years. When you do this, starting from that top-down approach, you don't have to be a genius at picking individual stocks. Those bigger trends are going to lift all the companies within that group. So even if you don't pick the very best performers, you're still going to get solid returns. So between the 11 stock sectors, start by picking 3 or 4 that are going to be driven by those larger forces. Our next step to picking stocks is going to be comparing the stocks within those sectors. Now, this doesn't mean you have to pick just one stock. You see that from the table of Warren Buffett investments before, that he owns 7 stocks within that banking group. All the stocks in that group are going to get a boost, but then you pick out the leaders for higher returns. So when I'm comparing stocks within a sector, I'm first looking at some fundamentals like profitability and growth. First, you compare revenue and earnings growth from the income statement. One thing you want to be careful of is revenue growth that's driven mostly by acquisitions. So if a company is just buying a lot of other companies and piling on debt, but it's not growing by itself, then it's no better than any other company that's growing revenue more slowly, but doing it organically. You can also compare cash flow from operations on the statement of cash flows. Now, this is a cleaner measure of growth because management can't manipulate actual cash flow like it can earnings. Finally, I'm also comparing the operating margin of companies. Now, this is the business's profitability and one of the most important measures of a leading company. It's pretty easy to find on the income statement. You just divide the operating income by the revenue. So that tells you how much profit the company is making after their expenses. You can also look at analyst reports available on investing platforms or read some of the news around the different companies. What you're looking for is what sets a company apart. Are there advantages like a strong brand or customer service that makes it a leader? Are there any catalysts in the outlook that could mean higher sales or profits? With just these first 2 rules to picking stocks, you've got a solid portfolio of leaders in a group that's going to benefit from those broader trends. That alone is going to drive higher returns on your money. But the real secret to investing, and this is something I had to learn over a decade as an analyst and an advisor, is that it's not about making money, but about not losing it that makes you successful. Not losing money on bad investments is how you really grow your wealth. So for that, there's just a few things you want to watch for to know when to sell a stock. These aren't going to keep you from losing any money, but they're going to help protect you from those biggest losses that destroy portfolios. And first here is a company producing all its growth from debt and acquisitions. Now, a lot of companies think making a big acquisition is going to fix their sales problem. They might even be losing sales, but they think that tying another boat onto their sinking ship, that's suddenly going to get both of them to float. For example, Teva had seen sales flat for 2 years and even fell by $620 million in 2015. That $40 billion acquisition helped them make another $2 billion in 2016, but at a huge cost in extra expense and interest payments. It doesn't take a financial nerd like myself to understand that buying another company isn't going to fix your broken one. If you own shares in a company that's losing sales and management can't do anything about it, the last thing you want them to do is to cover it up by acquiring other companies. They weren't able to manage that one company. How are they going to be able to manage it plus an acquisition now? So this is really two warning signs. First, that sales and earnings aren't growing. Second is that the company is taking billions on debt to acquire other companies and cover up its problems. Now, another thing that might tip you off to when you need to sell a stock is management departures, and specifically when the chief executive officer or the chief financial officer leaves. Now, this not only might signal that things aren't working right, but bringing on new management means it's going to take some time to get them on board and develop a new strategy. That's time that competitors are going to be eating their lunch and taking market share. Now, notice in all this, I didn't say anything about a falling stock price. That alone isn't a reason to sell a stock if it's still a good company. So use these simple steps we talked about to analyze the stock and decide if you want to hold on to it from here or if it's a good reason to sell. Part of knowing how to buy stocks and being a successful investor is seeing through those lies Wall Street tells investors. I was a part of this machine. I've seen how it works, and I can tell you that the investment industry isn't about making you money anymore. It's about getting those commissions, about getting those advertising dollars, and making the army of analysts and brokers rich. That's why I put together this special report, The 10 Lies Wall Street Tells Investors. It includes everything I saw that loses investors money, all those myths that nobody talks about, and how to play the game by your rules. It's completely free, just something I've done to thank you for subscribing and being part of the community. I'll leave a link to that in the video description below, so click through and get your copy. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just scroll down and ask it in the comments, and we'll answer it in a future video.